Good morning, everybody. Welcome to the Flow Show, Monday the 12th of February. A new week begins. Lots to get our teeth stuck into this week. Lots of data coming up, which we'll have a look at in a bit. Morning, Sir K-Man. Good weekend?
Hey, good morning, Ryan. Good morning, everybody. Yeah, I had a good weekend. Reasonably good. Then I had the misfortune of watching the Hammers against Arsenal.
Oh,
Well, let's not talk about football today, right?
Yeah, you probably watched more than me because I left after the fourth goal went in.
I trust that you were part of those thousands of people leaving the stadium early.
Yeah, as soon as the fourth went in, we went, and I think I was nearly back in Reading before the final whistle. So yeah, not the best day, not the best day out. Long way to go, but such is life. We'll move on quickly. Right, let's get into it then. The Bank of Japan apparently is looking at some new indices to try and define the labour cost impact on services inflation. Services inflation is the big key component for a lot of central banks and their inflation measuring tactics. So they're BOJ are going to be coming up with some new measures to look at that. No finer details that I've seen as of yet as to what they're going to include. Yeah, we'll see what that brings up. Whether they announce something before these wage talks, so it gives us something to keep an eye on to judge what they're going to be doing. We'll have to wait and see. But yeah, they're looking at more ways to counter services inflation. RBNZ's Governor Orr, a few of those bods were speaking last week, saying that inflation is still too high. No real embellishment on those comments, so take that as it is. Over in the UK, the Times reported a survey run by the BDO saying that the UK employment rate in the private sector fell to its lowest in a decade, suggesting that there's some jobs weakness coming in to the private sector there. This one's creeping up. Well, I wouldn't say it's creeping up now. We all know about it, but it's spreading. The ECB have now warned banks that it will basically increase capital charges or capital requirements if commercial real estate risk is not well managed. Now, we know we've got all this coming in from the US, particularly that New York Bank Corp and their exposure to real estate. We've had Yellen jumping up and citing the risks of real estate in the US. Well, now the ECB are warning their banks that they could be forced to hold higher capital requirements. That means let's call it putting money aside to cover potential losses if their risk is not well managed in the commercial real estate sector. Kate, this is it's sort of come upon us pretty quickly, but now it seems to be a bit of a thing, isn't it? That there's more than a few worried about commercial real estate and the bank's investment involvement in it.
Yeah, and recall what I said last week. It does look like the Chinese situation is also starting to let's say spread out a little bit. They're trying to sell stuff, including in the UK, by the way, Canary Wharf and the West End. Yeah, it's something that we definitely want to keep an eye on now, especially if you see that if the ECB is starting to force banks to increase their capital holdings against possible spillovers, that could see some moves in bond markets and why not in FX at one stage. You know, it's usually not very positive for a currency, but it's going to be the same everywhere. Again, I mean, you look at what's happening and how spread out. For instance, those Chinese real estate companies were. We can easily understand that it's going to put some pressure basically everywhere in the major countries, right? But it's something that we clearly need to keep an eye on, especially for those banking indexes and things, whether they at one point would start to weigh on some indices as well. But then I'm perhaps rather thinking about stuff like the Dow or S&P rather than the tech side of things.
Yeah. Now, I should probably explain for people who don't know how this all works. So, since the global financial crisis, central banks and financial regulators have put restrictions on banks so they don't get over leveraged or they don't have liabilities that exceed their bank reserves and all that sort of stuff. So, the capital requirements is a ratio that they put in place on effectively liabilities. So, if you've got 100 billion liability potential in or under management or in assets, whatever, to the commercial real estate sector, then you need to have something like 200 billion in reserves to cover that liability. And it's, they ratio it based on, worst case scenarios, not worst case scenarios. And then what central banks can do is, if they feel that a sector is under pressure, they can say, right, well, that 200 billion you've got in your capital requirement to cover that real estate now needs to be 300 billion. And then banks obviously have to find that money. And what they do is they stop other investments, stop other parts of their business to make sure that they up those requirements. Now, the long story short is that all these capital requirements, ratios, and all the MiFID II and everything that they've chucked at it, the regulations, should stop any systemic risk. So if commercial real estate blows up, yes, you may get a few of the smaller businesses, smaller banks like New York Bank Corp going pop and things like that, like we had with SVB, but it won't impact the broader financial system and the larger banks. It should all be contained. So that's something that keep in the back of your mind, because if this thing does start, if this snowball does start getting bigger, that's rolling, a lot of the market is going to start thinking, oh, here we go again, GFC 2.0, the world's going to end, financial system's going to blow up. That's unlikely to be the case, but it won't stop the market getting overly negative as it tends to do. But it will cause some pain, but the financial system should, touch wood, be sound because of all these regulations. So it could be a case, as I say, we trade the market getting too extreme when it doesn't need to be. But this thing is bubbling. We've heard it from the US. Now we've got the ECB warning about it. So it's just becoming a bit more of a rolling snowball, as I say. But that's how the regulations are supposed to handle it. So it shouldn't blow up the world. Famous last words. We'll timestamp that. Oh, actually, it'll be logged on YouTube later, so we can come back to it when the world does blow up. Right. Anyway, sticking with the ECB, ECB's Panetta says that the time for interest rate cuts is fast approaching. So we need to consider the pros and cons of cutting interest rates quickly and gradually. I don't know how quickly and gradually forms together, but anyway, as opposed to later and more aggressively, which could increase volatility in financial markets and impact economic activity. It then said any speculation on the exact timing of monetary easing would be a sterile exercise and disrespectful to the ECB Governing Council as a collegiate body. So it's telling everyone don't disrespect the ECB by trying to plan when they're going to cut. Yeah, good luck with that one. ECB's DeCoste says the March projections are going to be key for the rate path. There's the old can kick. Won't do anything until they get the next forecasts in March, according to DeCoste. German Finance Minister Lindner also jumping on the real estate bandwagon, saying that they see an adjustment period coming in commercial real estate. So, as I said, there's a lot of eyeballs beginning to lock onto this one. Fed's Bostic says inflation has been too high for too long, and there's still a ways to go for it to return to target. Fed's Logan says we have made tremendous progress on inflation, but there's more to do. We don't see any urgency to adjust rates. Right, quick look at the data that we got last week. Not a lot. It was Canada employment that came out on Friday afternoon. Decent numbers all round. Employment rising 37.3k. versus the 16k expected. Bit of a switch around on the old magic roundabout between full-time and part-time. Full-time falling 11k, was previously up 12k, and part-time rose 49k, was previously just nearly flat last month. Participation rate was down a little bit. Unemployment rate also down 5.7%, was expected to go up a pip. There were some hourly wage numbers. Have they got them on here? Yeah, there we go. 5.3%. That was as expected, down from 5.7%, but still running quite hot in that 5% handle. Job cuts front. Cisco, the latest tech company to announce losses, according to a Reuters piece, saying they are to cut thousands of jobs as it seeks to focus on high growth areas. They did have, as of fiscal 2023, some 85,000 workers there. So we have to wait and see how many thousands are getting the chop, or potentially getting the chop. I think their earnings call is Wednesday, Valentine's Day. So that's maybe where we'll hear what's coming from those guys. It's been a bit quiet on that headline front. Other than that, Kate, I don't know if you've got any bits and pieces you wanted to throw up.
What could have been market moving, I saw, was Moody's downgrading Pemex in Mexico, but the market has decided to completely shrug it off. No, in the aftermath of the Banxico, there hasn't been any more comments coming up. Well, what we see then closer to home is bit of troubles in the Tories party, right, Ryan? There's a lot of people walking out the door. There must have been West Ham supporters as well, saying like, "Wow, we're getting a bit hammered here. Let's get out of here." I wonder if this week is going to be some kind of I wouldn't call it a make or break week for politics and the sterling, because we've got a lot of sterling stuff coming up in the week. We'll have a look at that, I'm sure. But sterling should be on people's radar this week, I reckon, because we're going to have a lot of stuff coming out. So I do expect more than any headlines over the weekend for what's to come. I do expect the sterling will be on the move this week.
Yeah, very much so. Might as well have a look at that now then, to see what's coming up the date this week. Nothing today, not a lot out today. Tomorrow we get a few bits and pieces more CPI data kicking off. Obviously, the US CPI is going to be the big number tomorrow. UK jobs report tomorrow morning. This one's still a bit of a mess since they started messing around with their metrics and how they count it, and so it's largely going to be unreliable data, but numbers are the numbers, and the market's going to move on whatever the numbers are, whether they're right, wrong, or whatever. So just keep an eye on that one. I'll be looking at the wage numbers in that one particularly, just to see how things are faring. If we're getting the wage numbers, let me have a look. Yeah, so average earnings year on year looking to come down to 5.8% from 6.5%. So we need to see whether they come down that much or more, or remain sticky. That'll be a big input for the Bank of England. Wednesday, CPI in the UK as well. Excuse me. And then this week we're also starting to get some other flash GDP numbers for Q4 coming through as well. So Eurozone flash GDP, we'll see how crappy the fourth quarter was there. Keep an eye on Japanese GDP as well, see what's happening with those guys. Then on Thursday, big data slate, get some UK GDP industrial production numbers. Then into the US, retail sales is going to be quite a significant one to watch. You may recall last week I mentioned that consumer credit fell off a cliff for the month of January. For December. These are retail sales for January, so we may get a bit of feed through there. November and December were positive months on the retail sales, and we're expecting a small pullback, minus 0.1 to the headline number. But I'm wondering if it's going to be a bit worse than that. But we shall see.
Yeah, Ryan. One of
Yep.
the better forecasters, let's say, if we can express ourselves that way, because it's still a bit of a blind dance thing. But one of the better forecasters is expecting a little bit of a weaker retail sales, and we know that the consumer is extremely high on the watch list in at all central banks, but especially for the Fed. So I do think that the retail sales are going to be, after the CPI, probably the better market mover in the latter part of the week indeed. Yeah.
Yeah, very much. So as you can see there, headline sales expecting in at minus 0.1%. Takeout vehicles and gas, they're still expected to rise 0.2, 0.3%. You can see from these positive numbers we got last month. So yeah, it's not a linear thing that these consumer credit numbers equal what happens in the retail market, but the fact there was such big swings just in my experience leads me to believe that these numbers could be a little bit worse, if they are worse than what the markets are expecting. Conversely, if we do get a positive set of numbers all round, well, it's cups and saucers in the air and more Goldilocks data for everyone to scratch their heads about why the data's coming in so strong and everything else is pointing to potential weakness. So yeah, it's going to be an interesting one. That one, where are we going? Back here. We also start getting the regional manufacturing numbers kicking off as well. Both Empire and Philly Fed the same day. Usually they're a day or two apart. Empire is usually on a Monday or Tuesday. So these are all coming out at the same time. They've been a bit flaky of late, particularly the Empire has been all over the shop recently. So not really much of a bellwether for the rest of the numbers, but still we'll get those. Any big changes in those will likely get the market moving. Industrial production, housing market index there as well. Then Friday, the first hard data, housing data for January starts coming in, housing starts and permits. As I've been mentioning, the NBA numbers have been pretty solid in the early part of this year, January through February so far. So there's some indications that the jobs market may also start being a bit tickety-boo in the early part of this year, weather permitting. Obviously, we had a lot of weather coming in the latter part of December for the US, which can obviously impact at least the starts side of things, breaking ground, that sort of thing. PPI as well, that will add or subtract from what we saw on the CPI on Tuesday, because it can tell us that these numbers may be changing depending on what PPI does, because obviously PPI is a big input to that as well. So the CPI story may not be the end of it once we get that number. Watch the PPI on Friday. And the flash Michigan consumer sentiment numbers, again, might be a bit of a maker or breaker compared to what we got from retail sales, because retail sales is obviously for January. Consumer sentiment, the flash number is for February. So if we get a good retails here, and then all of a sudden the consumer looks bad in this number, again, it will take off some of the steam that we got in the retail sales and vice versa. So a pretty decent week of data. Should keep us ticking over, hopefully a bit busier than last week. And hopefully we'll get some prices moving this week, mate. What do you reckon?
Yeah, well, I guess so. I mean, I think it should. I've got a bit of problem with those GDP data, because we are halfway through Q1 and bringing up those Q4 numbers again. I don't know whether that's something that is going to be really very high on my watch list. But all the rest of the data could be market movers, and especially if we see data coming out the same side of the fence that, for instance, tomorrow we get a US CPI number up or down, and then the rest of the numbers confirming that side, then I think we are probably having a good chance of starting to break some of those ranges that have been built over the past week, or of the past week especially, right? If you look at stuff like euro, the commodity currencies, even the cable as well. Yen a
Yeah.
bit of an outlier, but if you look at all the rest, we are very firmly in ranges, and I'm hopeful that this week is going to change that picture a little bit. For those watching Swiss franc, for instance, I know that a good few are doing it, especially in our room. We've got the Swiss CPI tomorrow morning, and that in combination with what Jordan has been saying over the past weeks a couple of times could be an indicator. If we see a bit of a low print there, that is going to reinforce, I think, the fact and the opinion on the market that we are now well within S&B's range, and that could put another bit of pressure on Swiss, for instance. But that's one to watch for those who are exactly watching the Swiss franc. And if you want to steer away from dollars, that there may be something to do in some of those Swiss crosses, for instance. Yeah, but I'm hopeful that this week is going to be a mover. Yeah.
Yeah, I hope so. It's not looking too hot on the vols this morning. Dollar yen is now below 8%, again 7.93%. Euro dollar just below 6%. So yeah, things are quieting up a bit. But you know, big data means you could get a bit of a bigger move just on the initial reaction. I forgot to point out Aussie jobs Thursday as well, late Wednesday night, early Thursday, depending on where you are. So if you're trading the Aussie, that's one to watch there as well. Right, so let's have a look at what's going on in prices at the moment. Going to start with the S&P, which, as we all know, finally took out the 5,000 line. Had a quick spike up there and then a test all the way back down, and it held the break point. So it's doing exactly what it should do technically. When you break, you want to see the break held. That's what it's done. Now we're playing the little game of where's the top, where's the support coming in. So we had a bit of resistance coming in initially around the 50.25, and then it's just gyrating about there at the moment, trying to hold 50.25, which if it does, it should kick on up. But this is the same sort of price action that we had here, we had here. All these times we had these break moves. We need to watch what happens, and you get these little patterns. And I've been trying to, part of the exercise in trading this and charting it in our rooms and wherever, is just to show you how the price action develops, what happens, how things form after you get a break, and then another break, and then another break. You get these little moments where you have a move, and the price then decides what it wants to do. And if it keeps breaking higher, then the train doesn't stop. What you need to see is a significant period, and at the moment it's longer than 1 or 2 days where you can't get through a high. Once you start getting that 2, 3, 4 days of not getting through a high, that's when you start thinking that a top's in play. But if you've been trying to pick tops over the last couple of weeks, you wouldn't have been successful on that one. But it also gets harder and harder to buy at the top. When you're having a strong move such as this, since the 17th of January, it's just been a rocket. When you get moves like that, it's hard. Everyone wants to buy a dip, but when you don't get a dip, you end up chasing, which is why you get this sort of price action as well, where it doesn't pull back significantly. And then what happens is a lot of people get locked into longs up here. So the first sign of trouble, when it doesn't continue higher, that's when you get the steep pullbacks. So it's always something I'm watching in markets. The higher and faster it goes without a decent retrace, the more volatile that retrace is likely when it happens, because it catches out all the chasers. So from here, yeah, can it keep going? Yeah, it's not going to keep going forever. Even I know that. But forever in this market can be several more weeks, but we shall see. At all times, what you need to do if you're long is just protect what you got by raising your stop behind it, which is just what I've been doing with my longs. So yeah, this one, next decision is going to be 50.30, 50.25. Whichever way it breaks from that, that's likely where we'll get the next at least short-term direction for that one. Ali, just going back to your question, why not the best day? My football team lost 6-0. That's why not the best day, Ali. Long and short, a complete shit show to be honest with you. But enough from that. What else have we got going on? Just reading the questions. Yeah, Brian Kay's already answered that about the Swiss CPI. Ali wants to ask about euro sterling bottom. How long can a market go long on pound? Right. Well, price action wise, that's always key. We've been saying it hasn't been strong, or the pound's been strong, but the pair hasn't been strong. We've been in a downtrend pretty much all year, as you can see, but here we are. We can't get through the level. We said last week, both me and Kay speaking, yeah, we can talk about potential break, but we can also be sitting here 2 weeks later and still one hasn't happened. This is the nature of euro sterling. You need patience. It can go sideways for a long time. The fact it isn't breaking down after coming through the BOE, ECB and everything suggests that the market is happy with the level of where it's at. The fact that it's not bouncing significantly keeps the downtrend in play, and it keeps the pressure on this downside. So for now, sitting here, we know that the UK's had better data, but we're not moving any lower on this. The pound isn't gaining any more on this. So it's going to take something special, and this week could be it with this data, for this to gain further. We've got this UTAL retails coming out. We've got UK CPI coming out. I'm not too certain whether the numbers are going to be that good, particularly for retail sales, but then I thought they would be better last month and they weren't. So we may have had a bit of a washout in December and a bit of a bounce back in January. But I am siding with the fact that I would see data getting a little bit less positive, shall we say, coming into the new year. It's just something that can happen in the UK. So if that does happen, and as long as the Eurozone isn't collapsing, then this is probably likely to start just edging up a bit somewhat. But how high it goes, we'll have to wait and see. You can only go by the price action. So if you're trying to short the quid, Ali, this chart is giving you some signals that might be right, but it's also giving you signals that maybe it's not finished with the downside just yet. So for now, this is still the big zone, 85s, 84.80, more so 85.20 in the short term, because we're not even getting a test down to the big figure just yet. So that's the area you want to look at. We had another probe, couldn't get through it. So price action speaks for itself. Surprise, Kate. Euro dollar's trading at 107.70.
Oh my God, yeah. I just wanted to add on the sterling this week. I do expect a direction or a fresh direction or the next direction to possibly unfold on the sterling. And yeah, people know I've been very positive, well, very relatively positive in my trading as well towards the sterling over the past weeks, but I was long sterling Swiss as well, which was doing all right. But I've taken it off today just because of the importance of this week, and where I was relatively positive. It's always a bit of a mess on the UK political front, but I think the combination of the data and what's happening in the background for Sunak and co is making me just that little bit more cautious this week, going into this week on the sterling. So I'm okay to take up my positive sterling stance again, but I'm very neutral going into this week on sterling, whether it be cable, euro sterling, other sterling crosses, for instance, that sterling Swiss or so. We are still at decent levels in the sterling. We had this. The reason as well why I'm saying that, yeah, if you go onto the cable, we had this pretty decent bounce of the 125.25 when the dollar was behaving very well, and the cable really reacted very positively. So we do have levels to bank on and to rest on. You've got it in the euro sterling, you've got it in sterling yen, you've got it in the cable, you've got it in a lot of currency pairs. So. But this week could be a bit of a decision week for the sterling, for a new mood, if not trend, to unfold in sterling, because we have to, and I've been repeating that already a number of times as well. Sterling is sometimes a pretty emotional currency as well, and especially on the downside. So if we would get negative data coming out of sterling land this week, I expect sterling to get a little bit of a beating, because the market takes it relatively, as I said, emotionally, to trade sterling at times.
Yeah, and it always likes to hit the quid harder than it likes to bite.
Yeah.
I think again this week for the UK and for the US, with all the data coming, it's going to be a case of where do we close?
Yeah,
We said it after this move. When we look like we're breaking 126, everyone's here 120s, here we come, 124s, here we come, and boom, here we are back at 126 again. So it's always important you don't get overly enthusiastic about something unless it starts holding the break, which it didn't do here. So yeah, it's going to be big data for this one, but where we finished the week, we could go all the way down to 124 on bad CPI and whatever. And then if by the end of the week we're back at 126, that's going to tell you everything. So be prepared for moves, but like we've known all this year pretty much, is don't trust those moves as far as you can throw them. If you get on the right side, take some profit, lock in your stops behind, protect what you made, just in case it does reverse all the way back again. But also, if it does keep going, then you've got some in the trade and you can push it as far as you can. But yeah, again, the close will be important to me after all the data has gone under the bridge, because we've come through CPI reports, central banks, retail sales, all through this period, and we're still stuck in the range. So yeah, never say never for this one. Aussie dollar, this pattern's looking similar in a lot of dollar pairs. We just looked at euro dollar, had that move down. Now we're stepping up. Whether you want to call this a bear flag, whatever, possible. But for me, it's where a price has stopped going down for now. And now we look at these little lows here and there to see whether they start breaking again. If they do, then we're potentially going to continue the trend lower. If we don't, if we come down, hold this, 107.60 today, or maybe 107.40s, and then the lows down here, 107.20, 25. If we hold those on a retest, again, it gives you a bit of price pattern that we may be starting to form something a bit more solid in terms of a bottom. As I was going to say, Aussie dollar, similar picture. Came to the lows, bounced, came to a low just above it, bounced again. But as I've been saying, it's like deja vu this. Till we get through the zone, it keeps the bearish pressure on, and not much to do on that one. I've not got, it's not an awful lot happening, Kay, so I don't know if you've got anything different you want to show us. I'll have a quick look at gold maybe, which again isn't doing an awful lot, but it seems we're coming down to these low areas more than we're testing the highs. But maybe a bit of washing out coming here now. China's finally on its holidays, maybe a bit of buying's dried up. But this zone is still the important zone for me, 2010. Okay.
Yep.
I'll pass it over to you, mate. Oh, where's the button gone? There we go.
I think this week I want to look at to start the week, look at those US yields a little bit, and of course everybody is watching the tens, but I'll also have a look at the very at the near one. We're banging our head on the 420, right? 420, 422, and I would say add 425 to that. And going into CPI retail sales week in the US, I think we really need to watch what's going on here. If we start to push through here on a sticky CPI, helped by the retail sales, which are obviously later in the week, but it could be already happening on the CPI. We're going to have to monitor to see if a move up holds, or if we're going to really slowly go back to the low fours, where that seems to be the equilibrium zone, right? Somewhere between 405, 410, and then On the downside, I would argue that 390 is going to be a bigger level to watch as well. If we get back below, that may mean that CPI is really starting to come off, and that should get the dollar on the move as well if you would get a break below here. As Ryan was already mentioning, and we talk about that regularly on the shows, vols are coming off. The issue with that is that, of course, vols can spike higher if the numbers are going to be pretty far away from expectations. But if those vols continue to trade around here, that's going to be a difficult situation for us FX traders, because lower vols means more buyers of options because it's cheaper to buy options. That means also more sellers on top of ranges and buyers on bottoms of ranges because they want to make their premium back. So let's hope we get a number that takes us out of this zone. Top side would likely see, as I say, more upside on the dollar as well, and perhaps we can break those supports. I'm especially thinking on a pair like the euro dollar around that 107.1525, and thinking about the dollar yen hanging in the 149s now, the low 149s, and trying to make up its mind if we are going to, oh, here we go, hang on. If we're going to finally make a move above this 149.40, we see we've been a bit higher, but we could not take out that high here from November. Remember, that's where the dollar started to turn around. Then we had a lift up in yen crosses because the equities were fiercely rallying then, and the yen was and we had a bit of already comments on from the Bank of Japan as well, but we could not make it above 149.70, 149.75, and that on the US CPI is going to be our top side to watch, I guess. Before that, I don't think we can take it out. The market is rather in a manage my books before the event right now. So we are seeing a little bit of a setback, shying away from that zone. 148.80 is your first level to watch here. You see those prior tops. That's the first support to watch. If you look at it from a cloud point of view, they are much lower, especially the daily is only coming in around here, around that 146. And if you look at the bigger picture, that is going to be, although we have supports here, we know that the Ueda, Shimizu, Uchida all have been saying, don't count on us to start ramping up interest rates violently either. So I'd say this one, from the point of view of the Bank of Japan and then going into CPI, I'd say a sticky CPI has probably more chance of taking this up to 150.5 at one stage. That is what I'm looking at on the top side. On the downside, if you get tomorrow, if we get a really weak number, I guess we are going to have a look at what's happening in the 147.5 before we can talk about the big 146. That's where the cloud also comes in. The daily cloud comes in this week as well. So if anything, if CPI really goes down, if retail sales really show weak one in the US and the other data show weaker numbers, that is this one I would write down here, the 146 in dollar yen. Okay, and then a lot of us are in Swiss franc. We are still trying to look at the Swiss franc from the more negative point of view for Swiss. We do have that Swiss CPI tomorrow. And of course, the combination of the Swiss CPI, the US CPI, should force, I guess, a decision on what's happening, especially, or for a starter, with the cloud. The cloud is at 87.20. We've seen the break above, close above, and for 3 days now, we are the third day now, we are holding right there. It's also a bit of a, it's also a little bit of the prior high here, also trying to hold, but this is one to look at for the start of the week. If we get a close back into the cloud, I'd say there is a chance we go back to lower 86s. My big decision area, a little bit like the dollar yen, we will, if the combination of the US data and the Swiss data call for Swiss strength, I'm managing my dollar Swiss option. I still got a call running for a number of months, so I'm not in a hurry for as long as it moves really. But my favorite side is definitely the upside. I'm underhedged. But I think the first decision area is going to be 86.30s. The bigger one here is those levels where we bounced off around 85.5. Yeah, the cloud comes in a little bit lower, but if you look at it towards the end of the week, the cloud is coming closer to that level as well. To start next week, the cloud is going to be bang on the 85.5 as well. So this is my 146 in dollar yen, 85.5 in dollar Swiss. All right, and on the top side, we still have to break back above 88.1020. And look where the 100-day moving average comes in. The 200 lies a bit above, but for as long as we stay below that level, it's going to slowly come down, and they may all converge towards that 88.1020. This is my magic level still, okay? If it goes through, then I think in the medium term, something has changed. And we could go 89, and why not have a look at 90 at one stage? But that's really for the medium term. Okay, Ali. Yeah. But respect the levels, Ali. Okay, if tomorrow that CPI in the Switzerland and the US tell us something for the other side, be a bit careful, right? Really, you've already showed the Aussie. The Kiwi is also still banging its head against this resistance zone here. I'd still respect it, 61.40, 61.65. I'd still respect that zone because it's been trading inside there. We still have to break it. If we get those weaker CPI, US data CPI tomorrow, this may be on the move. Otherwise, I can see us continue to consolidate this block here with the underside around 60.70, 60.60. That's going to be major support now, I reckon, around there. And what else? Anything else to watch? People always ask about the cable. I don't see much in the cable. Although, as I said, there was this pretty interesting spike here, okay? That means that the market is still, in my opinion, quite positive towards sterling, but we will have to see what this week brings, all right? We've seen that we had trouble keeping the 127s, so that's going to be your top side zone to watch, 127, 127.5 for a starter. And then on the downside, you're looking at 125.80, and then this 125.25, 125.25, 124.80 decision time, I think, on the cable, right? Breaks back below there, could spell trouble for the sterling, okay? Open-minded here to start the week. And with that, Ryan, I'm going to give it back to you, mate, because I could show the MEX and the Chinese, but let's keep that for tomorrow.
For tomorrow. Yeah, and just if you're trading the quid, Bailey's speaking today, and then we've got him in Parliament, which will be his testimony on the monetary policy report that they issued. So it's like a press conference Mark II, but for politicians for that. So keep an eye on that one this week. And on that note, I think we've all set you up well enough for the week ahead. You all should know what's coming. No surprises from that front. And we shall see how things develop this week. Have a great day, everybody. Take care. We'll see you all tomorrow. Cheers, Kate.
Cheers, mate. Thanks, everybody.